Welcome back, welcome back. It's No Apologies on Beck, and I'm very, very, very happy to introduce our next guest, remoting in, Dr. Murray Sabrin, founder of the Sabrin Center for Free Enterprise. And wow, since you've agreed to come back on the show, I've been reading so much more about you, and I think we might have to have you on a weekly basis to get all of the information that I need from you. So thank you for agreeing to come back on.
Thank you.
Yes, and so there's so much to talk about. I know that you have a new book out, and that I find the topic fascinating, and so we do want to discuss that. Mm-hmm. Tell us a little bit about your book, and I think we have the
cover so that they can see.
Gentlemen, go ahead and pull up the cover of his book, and Murray, if you could tell us about this.
Well, I've been investigating the business cycle for literally 45 years since I became aware that there's a business cycle in America and what causes the business cycle. And when you drill down into the research that other people have done, it's clear that the Federal Reserve, by manipulating interest rates and creating money out of thin air, sets into motion the boom cycle, which is unsustainable. We saw that during the dot-com era. We saw it in the housing era. And now we're in really the fourth bubble. The third bubble ended with the lockdowns of early 2020. We had a boom that the Fed engineered by trying to stimulate the economy out of the Great Recession. And then the lockdown came, and so the economy went into free fall. And then the Fed really did something unprecedented in human history. They created literally $4 trillion overnight in order to stimulate the economy, because the federal government was borrowing so much money, and the Fed has been buying up $125 billion of mortgage-backed securities and treasury securities. And now we're in what people have called the everything bubble. Everything's inflated: housing, food, rents, gasoline prices, auto prices. Things are just going through the roof. And my prediction, Rick and Lori, is that I think next year we may see the first bout of double-digit inflation since the late 1970s and early 1980s.
Yeah, you know what? I think everything is pointing to that. There's no doubt about it. Now, with the BoomBus Cycle, and I know you're not a fan of the Fed because apparently you've got a book entitled "Why the Federal Reserve Sucks."
Yeah, I couldn't be more succinct in explaining how the Fed is really counterproductive, and that's a kind word to say. The Fed is really the enemy of financial and economic stability and economic growth, sustainable economic growth.
Agreed. And that's my understanding is, well, there's all sorts of perhaps malintent, but we're told the intent of the Federal Reserve was to mitigate or decrease the severity amplitude of the boom bust. And really what they do is just draw it out because of their mismanagement, if you will, and create something that's so much worse than what would be a natural cycle. Is that a fair statement?
Well, no, I think the notion that many economists have, which comes from Karl Marx, by the way, is that the free market is inherently unstable and prone to business cycles. Well, when you look at the data and you look at the research, the theoretical foundations of theories that explain the business cycle, I think correctly, it's because of central banking. Before central banking, we didn't have systematic cyclical ups and downs of the economy. What you had were wars that disrupted the economy, famines, the king confiscating the people's gold. Those caused depressions in the economic activity of a nation. But the systematic ups and downs have really been with us since central banking has been created. And before central banking was created in the United States in 1913, we had banking panics because the banks inflated the supply of money by creating notes that were not redeemable, that were excessive in terms of the gold reserves they had in the bank, in the vaults. And so people would run on the banks, and you'd get a bust in that community where the banks overextended themselves. So when the Fed was created at the behest of the banks, because they wanted a central organization, institution that would sort of coordinate the inflation of money and credit in the economy. And guess what they've given us? They've given us a whole host of depressions since 1913, when they were created. The Forgotten Depression after World War I, of course, the Great Depression everyone knows about, and a series of recessions since World War II, and then the big Great Recession of 2007, 2009.
I see. So prior to the Fed, then, it wasn't a true cycle, but there was event-caused temporary aberrancies. And so now we actually have, because it's like a dog chasing its tail, more or less. They're always trying to correct what they've just caused.
Well, here's the amazing thing that I've concluded after doing all this research for this book, is that the American entrepreneur, all the great men and women that innovate, that invent, that create, they're going to go ahead full speed in creating goods and services that the people want, and they have to navigate the boom-bust cycle. That's the title of the book. How do you navigate the boom-bust cycle when the Fed is throwing all these policies at the economy that destabilizes the economy and creates false signals to business people that they should expand rapidly because there's so much great demand in the economy? And that's what we saw during the dot-com bubble. That's what we saw during the housing bubble. And now we're seeing it now again in literally every sector of the economy. In addition, you have all these government policies that are disrupting the supply chain, which never would happen in a free market, because in a free market, the whole purpose of entrepreneurship is to get goods and services to the people in a smooth fashion. And so the conclusion I've reached a long time ago, and it's borne out by policies, is that let the economy run itself. We don't need all the so-called smart people in the Federal Reserve and Washington try to run the economy. It's a fool's errand.
Yeah. You know, part of the book is for entrepreneurs how to navigate. So it's anticipating, seeing some of the signs, and how do you respond. Now, the biggest problem I have, and I hope you can help explain this,
Sure,
is we can anticipate inflation. But along with inflation, we would expect normally interest rates to rise significantly.
right.
But I think they've boxed them, because of the tremendous amount of debt that our nation is in, we've kind of boxed ourselves in. How do you increase interest rates to counter inflation when increasing interest rates are going to make you go under?
This is the conundrum that the Federal Reserve has created for itself after more than 100 years of trying to, quote, manage the economy. They just can't do it. And so by manipulating interest rates, they've given us this incredible bubble in the US economy that ends poorly. The question is, when does it end? And I go into the book to look at and show signs that people can look at as to when the bubble is going to burst. In fact, I pointed out in the book that we were headed for a recession in 2020, because at the end of 2019, the yield curve inverted. That means that short-term rates went above long-term rates because the Fed was reducing the growth of the money supply. And that always precedes a recession, which is basically a correction to the previous inflating policies of the Federal Reserve. And so we were headed for a recession, but COVID hit, and then the economy fell off the cliff because of the lockdowns. And then the Fed really put their foot on the gas and created, as I pointed out, $4 trillion in literally weeks, which is more than the Fed had created in 100 plus years of its existence.
Mm-hmm.
Yeah, absolutely. All right, Murray, we're going to take a break here. We're going to have you back in our next segment. I've got plenty of more questions. Folks, stick around. We will be right back. All right, we are back. It's No Apologies on Beck, your after-hours oasis of sanity. I'm your host, Rick Becker, co-host Lori Hintz, and our special guest, Emeritus Professor of Finance, Dr. Murray Sabrin, back in the house.
From Ramapo College.
Welcome back.
In New Jersey,
Thank you.
right?
Thank you, Rick and Lori.
Yeah. Okay, so we broke and we were talking about your book. And go ahead, guys, and yeah, thank you so much, because we want to plug this book. I've not read it, Murray, I'm not going to lie to you, but I am probably tonight, if not tomorrow, gonna order this because I'm fascinated by it. So, Navigating the Boom-Bust Cycle, an Entrepreneur's Survival Guide. So let's talk about that for just a second. I do have a question, because I listened to your interview recently with Tom Woods. I enjoy Tom Woods quite a bit, and part of that discussion was about the opportunity. If you're aware, if someone buys your book and reads it, they will become aware of the timing and likelihood of a significant downturn in the economy. And it's that, to that individual or that business's advancement, to recognize it and jump on it, because that's a time when you can expand your business at a lower cost or buy additional capital or whatever it might be. But my big question is this: we know that inflation is coming, and so typically you want to spend your money, right, before the prices go up. So is it a matter of simply understanding that you have to hold, and kind of like in Braveheart, you hold the line, hold, and then when you have been patient enough, you understand this is the time, this is where prices are going to be at? Describe the train of thought of the entrepreneur after reading your book of what they may be looking for and how they may act?
Yeah, this is a good example today of what we're seeing that entrepreneurs have to grapple with. As their costs go up, because commodity prices are going through the roof, we have supply chain issues, which is not a cyclical problem, but it's basically a problem caused by government mismanagement in terms of having all these lockdowns and shortages that we're finding all over the world. So if you're an entrepreneur and your costs are going up, the question is, do you try to pass on those costs to your consumer? Because we know consumers are resistant to higher prices. On the other hand, consumers may say, I better buy this quickly today because I don't want to buy this at a higher price a month from now, 2 months from now. And so if you're a consumer and you're concerned about inflation and you think it's going to really increase dramatically for the next year, which is probably going to happen given the money supply growth in 2020, remember, if you buy something today that goes up 10% in a year, you're saving 10% of your money. So what people do, and we saw this during the 1970s when we had 2 bouts of double-digit inflation, people started buying in expectation of prices going up. That keeps on fueling prices going up until the Fed realizes that they've got a real problem by that. That they're dealing with, and they have a tiger by the tail. And that's when they start raising interest rates, which Paul Volcker did in the late 70s and early 80s to try to squash the inflation, which he successfully did as the rate of inflation went from 12% annually to 3% in a couple of years. So if you're an entrepreneur, you really have to have a good plan in place when you're facing an inflationary cycle. And that means being more efficient in what you produce, getting good ideas from your employees, which is very important, and trying to make sure that consumers are getting value for your product. And that may mean increasing your marketing budget to induce consumers to say, my product is as good as it has been in the past, and it's may even be better because we've done some things to give you greater value. Because remember, consumers are looking for value these days. They're not looking just to stuff their house with inventory from Amazon or any of the big box stores. They want value for their dollars. They work hard for their dollars. And so this is where the whole proposition comes in. What are the entrepreneurs doing to satisfy consumer demand in a rising inflationary environment?
That's very interesting to me, because what I heard you say was marketing, and that tells me you need to advertise your product, which is very counterintuitive. I think people want to hunker down, just wait and see what's going on. But you're saying you need to advertise.
Well, the internet is a great place where people can advertise at a relatively inexpensive way. And newspapers may be able to give you special deals with, they have to be sensitive also to companies' advertising dollars as well. So again, everything in the world is negotiable, right? Everything is negotiable. So in this type of environment, you try to get the best deal possible. And we know consumers are having a hard time getting good deals for automobiles because demand is so high today. And there are shortages across the board for new cars and for used cars. So again, you see the prices for new cars. That's why I'm glad I'm not in the market for a new car. But next year we may be in the market for a new house, and we know prices across the country, especially here in Southwest Florida, are just going through the roof.
Mm-hmm, mm-hmm.
Yeah, interesting. Murray, I've got a question for you. You know, I've read recently about a comparison with the U.S. And the inflation that's coming, and the behavior of the consumer is sort of mitigated or delayed. They make a comparison to what happened in Germany after World War I, where prices were increasing, but the consumers were okay with it because they felt it was very temporary. And in America, maybe across the world, we're sort of okay with it. We accept it because we think it's temporary because of COVID. And that behavior to not be alarmed sort of mitigates or delays the bubble burst, if you will, or the inflation skyrocketing. But just on Mises.org today, I saw where there is an awareness that very soon the consumer is going to realize that this is not a temporary thing. Consumers' behavior changes. Do you see that this is likely the pattern? And if so, where do we see the impact?
You described exactly the pattern that typically happens during an inflationary cycle. Prices go up, and people say, "Hey, prices are up. I don't want to pay those prices. I'm going to hold back and wait till prices come down." Then prices don't come down, and then people start buying in anticipation of higher prices. And then you reach the final phase, which happened in Germany in 1923, the so-called crack-up boom, where prices just rise exponentially, and people just get rid of their money as quickly as possible. And we've all seen pictures of people with real wheelbarrows with money. And the famous story in Germany was people went to the store with the wheelbarrows full of money. They left it outside, and guess what? People stole the wheelbarrow, left the money there because it was worthless.
Yeah, that's phenomenal.
It is.
Now, that would be, I don't know, is there a definition of hyperinflation? And do you think the U.S. is headed toward hyperinflation?
Well, I remember years ago when I did my dissertation, 40 years ago. In fact, this is the 40th anniversary of my dissertation on inflation. One economist in one of the articles I read, he defined hyperinflation as 50% increase in prices per month. Now, we haven't come anywhere near that in the United States, but there was hyperinflation during the Confederacy, during the Civil War, because they were printing up tons of money in order to pay the soldiers and buy supplies, and they did have hyperinflation. We did have hyperinflation during the American Revolution, where the Congress printed up continental dollars, and they became eventually worthless. Fortunately, we haven't seen anything like that in the United States, but there is a possibility that we could see accelerating inflation to 2022 and possibly even to 2023. Because if you look at the inflation cycle in America for the past half century, the acceleration phase usually takes place over 3-4 years. So if this year is the first year of this new cycle, then we could be another 3-4 years into this cycle of accelerating inflation.
That is so interesting to me because you know what happens in 2024, an election. And lots of stuff can happen when that changes things. So.
Oh yeah, economy drives election results, that's for sure. All right, Dr. Sabrin has been gracious enough to agree to stay on for a third segment. Ladies and gentlemen, we will be right back. Stick with us. All right, we are back. It's No Apologies on Beck, and we have Dr. Murray Sabrin with us. Wonderful, wonderful discussion regarding inflation. He's got a new book out. We'll put it up one last time. I think this is a book that would be well worth your read, ladies and gentlemen, because the boom-bust cycle is real, and the bust part of that cycle is coming.
Imminent.
This is an entrepreneur's survival guide by Dr. Murray Sabrin. All right, Murray, very, very good talking with you. Lori was just talking with me during the break about an op-ed you recently wrote. So. Right,
and it's an interesting op-ed too, and it maybe hasn't even been published yet, I'm not certain, but it is titled "The Federal Reserve's Assault on Savers Continues." That was interesting to me because I view the American public as not particularly great at saving, but I'd be very curious as to what you say in this.
Well, the reason I wrote this is because I think the American people should be up in arms about what's happening to their savings accounts, their money market funds, their time deposits. When we had the double-digit inflation of the late 70s and early 80s, when inflation was running at 12%, we were getting 14% on our savings accounts and our money market account. And so today, inflation year to year is running 5%. And guess what we're getting in our savings account? Virtually zero. So this means that if you are fortunate enough to have $100,000 in a savings account or a money market fund, you should have gotten 5% of that $100,000 for the past year to at least match the rate of inflation of $5,000. Instead, you got virtually zero. That means the inflation tax is really big. It's $5,000 for that person who has $100,000 in a checking account. In a savings account or a money market account. This I consider highway robbery. I mean, when I taught corporate finance and securities investments, one thing the students learn is that the rate of interest, the rate that we get on our money that we lend to institutions should be the so-called real rate, which historically is around 2%, plus the inflation premium. Well, if you add that up, 2% plus 5% is 7%. We should be getting 7% on our money market funds and our savings accounts. Instead, the Federal Reserve has depressed interest rates in order to help the federal government borrow money at zero interest rate. to finance their debt. And it's a huge windfall for people on Wall Street who are borrowing money to buy stocks and other financial assets at very low interest rates. And who's paying the price for it is the savers, the retirees who are on fixed incomes. So if a retiree has $100,000, or let's say a best case scenario, someone really saved a lot of money, they got $200,000 in a savings account, they should be getting at 5%. They're losing $10,000 a year in purchasing power that's really being transferred to the federal government and to Wall Street. And I don't know why the American people are not outraged at this. That's why I wrote the op-ed, and I hope it gets wide distribution once it's published, hopefully very soon. And I sent it out to someone who I'm working with in order to promote the book. And I'll have a series of op-eds over the next several months discussing how the Federal Reserve is really, if you think about it, it's the financial enemy of the people.
See, we can have him on again because he'll have other op-eds.
Absolutely. Well, plus, not only that, we have to have you on again because I want to still talk about free market solutions to healthcare because I have my own theory. Maybe it's not for the show. Maybe it's for you to fly out to North Dakota and have a bourbon with me, and we can solve the problem, or I can learn about your solutions. But
he's in Florida. So it'll be a tough sell. So maybe, you'll have to go down and interview him.
Well, we have the Hertz Arena near us, so maybe we can fill the Hertz Arena.
Right. The question that I think keeps coming to my mind is the idea of what a typical person does. Not maybe someone who was able to save $200,000 in their savings account, but has $5,000 in their savings account. And they're looking and they have the option of getting 0.01% interest or 0.2% interest if they're really lucky, and they think they're doing great because they have 0.2, not being aware, as you've said, of this sort of stealth tax, if you will, because every year that they have it there, they're losing 5%. How does a person who isn't able to save $200,000 sort of address this issue? Is there anything that can be done?
Well, this relates back to the previous segment. If you really think inflation is going to be 5% or more for the next year, you can stock up on non-perishable items, so you'll be earning 5% on the money that you would had in the bank, and you can buy goods and services that will be going up, 5% in price over the next year. So you've saved 5%. That's one way of beating the inflation tax. So there are no simple answers to this. One obvious way is if you think gold and silver will be good to you, they'll hold their value in an inflationary environment. You can put some of your funds into silver coins, the so-called junk silver, the coins that were produced before 1965 that have 90% silver content in them. Or maybe buy some small denomination gold coins, or 1/10 of an ounce or 1/4 of an ounce. So that's what people did in the 1970s to beat the inflation that was raging in the 1970s. But for the average person, it's tough because the Federal Reserve is not consumer friendly to low income and middle income folks.
Yeah, and this brings me around to a point, not to digress too much, but all of these interventions from the federal government or the Federal Reserve, they actually exacerbate this issue of income disparity.
Absolutely.
All of these things, there's ways for people with a ton of money to get around this, to figure out what to do, how to protect, how to shelter, how to diversify. But you have average, John Q. Public and Jane Q. Public that they're not aware, and to whatever degree they are aware, there's very little they can do. But I love your suggestion with durable goods, if you will, that to buy those now and they have an increasing valuation, that's just as good, it's better than money in the bank. It's just as good as though you were getting a decent interest rate on your money in the bank. And
the beauty part of it, it's not taxable. So if you buy an item today that's $10, that's going to be $15 next year, you'll save $5 on that item. That's basically a return on your money that you spent today without having to be taxed.
Yep.
Yeah, I love that. That's a great way of looking at it.
Right in the last minute here, my question is it's not even as much of a question as it is a statement. It seems to me that the way you talk in your book is to give people of all sizes of business, a small business, a large corporation, the same sort of common sense attitude with regard to your advice in this book.
there's a lot to unpack in this book, and I really spent a lot of time thinking about what's the best way that people can navigate the BoomBus cycle. And I've gotten a lot of compliments. We have 4 testimonials in the front of the book, and I'm really proud of this book because it's really my first book on business as a practical guide for the business community.
Well, we are hoping that people can order this book soon because I think it's going to be super valuable to anybody in any size business. So
yes. Murray, thank you so much for being with us. Hopefully we can have you on for a third time because I do enjoy these types of conversations, and I find your insight invaluable. Thank you.
Thank you so
Thanks
much,
so much,
Rick.
Murray.
And Laurie, great seeing you again. And stay warm this winter.
Yeah, stay warm, exactly.
Will do.